Gold has done well traditionally when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. So again, let's look at the math. Although the government would have you believe that the deterioration of the US dollar is only 2.6% compounded, that's the CPI, or as I like to call it, the CP lie, common sense says that the deterioration of your dollar is much higher. First of all, the CPI doesn't include tax. And I guess, Anthony, if I didn't have to pay the tax, I wouldn't complain so much about the index. I believe that if your listeners conducted a common sense thought experiment, they could challenge the CPI easily. Put together a basket of goods and services that you used in 2020 and still use today. Your car, gasoline, rent or mortgages, health insurance, health care, groceries. What you will learn by constructing your own basket of goods and services is that the purchasing power of your savings is declining by more like 7.5% or 8% a year than 2.5 or 2.6 a year. Now, let's put that in the context of your savings. The world's premier saving instrument, the one that everyone else is priced against, is the US 10-year Treasury, the world's benchmark Treasury. Using it as a proxy for savings, if somebody buys the US 10-year Treasury today, the US government solemnly swears to pay them, 4.5% or something like that? In a currency where their purchasing power is declining by 7.5% a year, which is to say, if you save money and you loan it to the US government, they will cost you 3% a year compounded for 10 years. In 10 years, they will give you back about 60% of the purchasing power that you gave them now. What could make you more nervous about the maintenance of the purchasing power of your savings than a government guarantee that they were going to cost you 40% of those savings over 10 years? I would suggest that if history is prologue, that the current rate of the deterioration of the purchasing power of the US dollar relative to the yield that is commonly available to savers almost guarantees that the gold price continues to do well. And by the way, Anthony, I think it's important to note that this performance in the gold price, while it's become more noticeable of late, has been going on for a very, very long time. When people in these interviews say to me, or said to me a year ago, Rick, when is the gold price going to finally move? I would say, I think it's going to finally move beginning in the year 2000. In 2000, the gold price was $250 an ounce. Now it's $3,000 an ounce. 25 years, gold is up 8.5% or 9% compounded for 25 years. Gold has been maintaining its purchasing power while the purchasing power of the dollar has been deteriorating, and it's done so for 25 years. I'm attracted to the whole precious metals suite, but in my experience as a as an investor, Anthony, I have noticed that precious metals bull markets are led by gold. They're led by the fear buyer. When the price momentum in gold becomes noticeable to the generalist investor, when the generalist investor comes down into the precious metal space, perhaps because of its lower unit cost, silver begins to outperform gold. We haven't seen that occur yet, and I'm not actually really sure why it happens. I've just noticed that in 3 prior bull markets, it has happened. When the generalist investor becomes attracted to the precious metals narrative as a consequence of the momentum in the gold price, leadership changes to silver, and silver then moves further and faster than gold. I think from the point of view of platinum and palladium, that they are cheap, not merely relative to gold or silver, but relative to a basket of commodities, and in particular relative to the utility that they command as industrial materials. And I think that they will do well over time. But I believe that from an investment perspective, gold right now will maintain its leadership role. I think it's important to note that until very recently, most of the move in the gold price has happened as a consequence of central bank buying. And I think you need to look at the causes of that. The first cause of that would, of course, be the weaponization of the US dollar. The US government, abusing its status as the issuer of the world's reserve currency by, among other things, manipulating the SWIFT banking system, international property, not American property, and also, irrespective of how you feel about Russia's actions in the Ukraine, stealing $300 billion in Russian treasuries. That action caused many countries that would ordinarily keep their savings in U.S. treasuries to consider again if they would earn the ire of the U.S. government, let's say, as an example, if they were China or Iran or India, whether or not they could afford to keep their savings in a country that would steal their savings. The second thing, of course, is that the math that I described, the yield on U.S. treasuries relative to the decline in the purchasing power of U.S. treasuries has come to cause those countries to believe that in addition to the fact that U.S. treasuries are a dangerous asset class, they're an unattractive asset class for simply arithmetic purposes. When people asked me last year, I can no longer say this, when people asked me last year why the gold price was going up faster than the gold stocks, I had an easy answer. The gold price was going up because foreign central banks were buying gold, but foreign central banks weren't buying gold stocks. The buyer that was causing the price action was absent from one asset class while they were prevalent in the other. Just recently, the last 12 weeks, you've seen retail inflows into precious metals ETFs, the physical ETFs, which means that the retail buyer, the individual buyer, is coming back into the physical gold market. And that same buyer is buying gold stocks. So now you're seeing a rally in both asset classes, which is very consistent with prior bull markets. I don't see any way, Anthony, that our society can deal with $130 trillion in debt when our private net worth is $141 trillion. I think that the only way out is inflating away the net present value of our obligation while politically honoring the nominal value of our obligation. And if the social response to the deterioration of the purchasing power of the US dollar is the same as investor responses has been for a millennium, gold should be a real beneficiary of that trend. Right. Oil and more recently copper seems to be suggesting to us that investors are afraid of a recession. Certainly oil responds to immediate rather than longer term economic pessimism. And it could be that on a global basis, we're experiencing an economic slowdown. That's what the oil price would seem to suggest. Looking longer term, the increase in oil production was largely a function of one country, the United States. And my nervousness as a U.S. oil investor, and I am a U.S. oil investor, is that most of the increase in production that we've seen in the United States is a consequence both of a very low cost of capital for American producers, but more importantly, the conjunction of various new exploration and production technologies. That production growth, particularly in the Permian Basin of the United States, would seem to be slowing, which is to say the industry believes that in terms of their grade A undeveloped locations, that they've drilled about 85% of their inventory, so they have 15% less to drill. The attractiveness of those locations left to drill is a function, A, of the technology. So if technology improves, that number could increase, but also the cost of capital, and interest rates are rising, and the price of oil, and the price of oil is falling. One could expect, with the diminished number of grade A locations and the increasing cost of capital and the decreasing oil price, that the ability of the United States to continue to supply the oil and gas that the world needs in transition is declining. And the consequence of that is that I think you see oil prices in 2 or 3 years not merely higher, but probably substantially higher than they are today. I'm not an economist, but I noticed that it's been a very long time since we had a proper recession, an economic slowdown. Looking longer term, and by longer term, I mean 5 to 7 years, I think it's important to look on the bright side, because I think the side is mostly bright. There are 8 billion people on Earth, and we've done a wonderful job over the last 40 years of increasing the material living standards of the poorest of the poor in the world. But there's still a job to do. There's 1 billion people left on Earth with no access to primary electricity. My suspicion is over the next 20 years, they get it. That means that demand for power, first of all, is going to go up. And it means that demand for the stuff to get the power from where it's produced to where it's consumed, mostly copper, also goes up. So I think the ascent of humankind will be an important component of the increase in copper demand. Meanwhile, for 30 years, we have underinvested in copper supply, in exploration, in development, in construction, in production, in sustaining capital investments. These two lines, reduced supply as a consequence of constrained investment and increasing demand, will, I think, over 5 years and 6 years and 7 years and 10 years, do a job on the copper price. The other thing that will do a job on the copper price is mere inflation, which is to say, the real price of copper might not rise an awful lot, but the nominal price of copper, expressed in US dollars or euros or renminbi or British pounds, could go up substantially. And inflation does a different thing. It raises the capital cost to put new capacity in production, which is to say, if we were to go build a big porphyry mine today for $10 billion, 10 years from now, putting that same mine into production might cost $40 billion, which means that the existing production is that much more valuable because you have already amortized the expense of putting it in production. So inflation aids, at the very least, the nominal as opposed to the real price performance of natural resources.